Welcome, everyone, and thank you for taking the time to join us today. So we're really excited to introduce this opportunity within the WCG Growth Fund. This is a five-part mobile home park portfolio located in Northeast Alabama. This portfolio consists of 283 lots across five communities and represents exactly the type of deal our fund is designed to pursue. Assets with strong in-place cash flow and clear operational upside. So our goal with this investment and with the fund as a whole is to address the growing affordable housing shortage in America by acquiring and improving mobile home park communities, creating clean, safe, and well-managed environments that residents can be proud to call home. Our strategy is centered around acquiring underperforming but stable communities, enhancing operations, and driving long-term value while delivering consistent cash flow, tax advantages, and resilience through different market cycles. Next slide, please.
Oh, okay.
So before we begin, I want to quickly cover the standard disclosures. This presentation is for informational purposes only and is intended for accredited investors. Nothing discussed today should be considered tax, legal, or investment advice. All projected returns and benefits are estimates and subject to change. As always, investors should review the official offering documents and consult with your CPAs or advisors before making any investment decisions. Next slide, please. So let's start with the bigger picture. The U.S. is currently short about 3.8 million homes, but that number only really matters when you translate it into what really the impact. So that's millions of families who simply can't find affordable housing. And the key point here is that this problem isn't stabilizing. It's actually getting worse. So next slide. When you look at a level deeper, one half of renters in the US are now considered cost burdened. At the same time, the average home price has crossed the $400,000 mark, pushing ownership out of reach for many working families. So where do people go? So today, over 22 million Americans live in mobile home communities, and that number continues to grow because it's one of the last truly affordable housing options left. Next slide, please. So now here's where things get really interesting, right? On the supply side, almost no mobile home parks are being built. Zoning restrictions, land cost, and community oppositions have essentially shut down new developments. At the same time, large institutional investors are actively buying existing parks. So what you're left with is a very simple equation, right? Fixed supply and a growing demand. Next slide, please. And that's where the opportunity comes in. So mobile home parks operate very differently than apartments. Residents own their homes. We own the land. That means lower expenses, less turnover, and more predictable cash flow. And importantly, in many cases, rents are still below market, so which gives us a clear path to create value through operations. Next slide, please. So when you take a step back, this asset class checks a lot of boxes. It tends to perform well in downturns because demand of affordable housing increases, operating costs are lower than traditional multifamily, and tenant turnover is naturally low because moving a home can be very costly. It could be from $10,000 or more. So that creates a level of stability that is hard to find elsewhere. Next slide, please. So before we discuss the investment itself, I want to introduce the WCG team. So I'm Vinny Carriage, and I have a background in engineering leadership. I oversee the investor relations and focus on transparency, reporting, and communication with investors. The pretty girl next to me, she shares my last name. She's my wife, and she leads the due diligence process and helps ensure every opportunity aligns with the business plan and underwriting standards. Um, we're very family focused. Even our 8-year-old daughter gets involved with the business. So we are people oriented and family focused. Tim, would you like to introduce yourself?
Yeah, thanks, Vinny. Hey y'all, I'm Tim. I've been buying mobile home parks for about 6.5 years, retired nurse. Um, and was really attracted to the stability of mobile home parks. And I had an idea about it, why I would like it about, 6.5 years ago when I bought that first one. And time and time and time again, I keep coming back to this asset because of how stable it is and how heavy the need is, how heavy the demand is for them. So yeah, I nerd out on like all things mobile home parks. It's so much fun. And it provides so much value to the world that I'm super proud of what we're able to do. Matthias, you want to introduce yourself?
Absolutely. Thanks, guys. Yeah, Matthias Grünwald. I'm the operations lead at WCG Investments, husband and father of one, based out of Tampa, Florida. I have 18 years plus of operations experience based on my W-2 when I moved from Germany back in 2012 to the United States. I was leading North American manufacturing facilities all across North America, from Detroit down to Mexico. And using that skill set now from my W-2 in the real estate world. I've been in real estate since 2021, started with a duplex, then moved on to a fourplex, and then I went to commercial real estate. And at some point, I met these incredible partners with Tim and Vinny, and they showed me the dark side of the commercial real estate side, which is mobile home park investing. And all I was looking for when I started in real estate was tax benefits and cash flow. Oh man, and mobile home parks do it. And that's why I'm here.
Awesome.
Awesome. Thanks, Matthias. I'll take it from here. Um, and thanks, Vinny, for starting us out. Yeah, so our track record, I was saying how the more I do this, the more I'm really into mobile home parks, and that's what we do. It's all we do. We don't mess around with any other asset class. We don't maybe gonna do this, maybe gonna do that. We have our blinders on, and we know what we're really good at. We know how to operate mobile home parks. We know how to increase the value, and really, I mean, this has, a snapshot of what we have done and what we are still operating. But the big takeaway here is we do the same thing over and over and over and over again. We like the predictability. We like the consistent cash flow. We like everything about these, and are always focused on like, okay, how can we operate this a little better? How can we bring more value to investors and to tenants and everyone involved. So yeah, the big thing is sure, we've doubled people's money in 14 months. We've refied, we've gotten people all their money back. We are in current refis looking to get people all their money back and stay in the deal in the same equity position. But yeah, the big thing is we're boring and we like boring because that brings that consistent cash flow. So Vinny mentioned this is a fund, and this is the flagship deal within that fund. So it's a smaller $5 million fund that will probably cap it at about $4.5 million. Um, and this is about $3.9 million of that entire fund. So we're really showcasing this deal because it's the majority of it. So it is in Northeast Alabama. It is a nice secondary market. It's outside of Birmingham, about an hour outside of Birmingham, off the 20 highway. Um, and it sits exactly with what we do. We're not buying in Atlanta, we're not buying in Charlotte, we're not buying in Charleston because the prices don't make sense there. We're not able to get the returns for y'all in the same way that we can with something in a secondary market. Um, all of that said, there's still a lot of life in the Anniston Oxford Jacksonville MSAs. There's still a lot of economic drivers. There's still a lot of people. There's a lot of need for the affordable housing. Um, and what's really good about this is that it's a nice cluster of mobile home parks where we can really have operational excellence through the little bit of scale in a small area. Um, and yeah, I've been, Matthias has been a couple times. Vinny's been. It's just, it's a smaller town, but it's an area where you can definitely sense that there's life, that there's people working, and that's what we always look for. We make sure that there's people who are working who can afford the rent that we're charging. So, yeah, we're really excited about this market. Um, and then specifically, again, this deal within the fund. So we are buying this from someone who doesn't want to be in Alabama anymore. Um, Not because there's an issue with the deal, just because he's moving and consolidating. And this is something that we had been talking with the broker about for, ooh, 6 months on and off before we got it under contract, I think. And it's just one of those things. We followed up and we made an offer and we followed up. And when the time was right, the seller came back to us and said, yes, I would like to close with y'all. Um, so yeah, originally was eight and a quarter, $8.25 million, negotiated down to $7.85 million, about 27,000, 28 almost a lot. And again, I'm totally going to sound like a broken record here, but it's intentional. This is what we do. This is what we've had success in doing, and that's why we like doing it so much. We'll go up on the rent slowly but surely because they're under market rents. We will infill 21 vacant lots, not all in the first year, a little bit each year. We will fix up the vacant park-owned homes, not all in the first year. It's all based in that 7-year pro forma. So we make sure we have a long runtime because we want to make sure that this deal works. If, worst case scenario, this deal's working for everyone involved. We don't promise that we're going to do all this crazy things that we know isn't going to happen because we've done it so much. So we make sure that the deal works in a very conservative basis. Um, and yeah, making the parks a little bit nicer for everyone, doing some road work, doing some lighting, adding some security cameras, just stuff that we've done in every other acquisition that has really seemed to improve the entire the parks. Um, and yeah, what I'm proud of, your in-place cash flow is your in-place NOI, sorry, is $818,000. And we're buying it. So what we're buying it for 7.85 million. So on a global cash flow level, we're buying it better than a 10 cap. I want to say it's 10.4. So it produces a ton of cash. Even if we do nothing, it's producing a lot of cash and able to get returns, projected returns to everyone involved. And yeah, I mean, I don't know about you guys, but I love the high DSCR, meaning, the high debt service coverage ratio, meaning that it's a safe deal. It's not something where if a handful of people stop paying, that like we are all hands on deck and how are we going to right this ship? It's like, oh, okay, like we'll do what we always do. We'll file eviction but it's not going to make anyone lose sleep. It's not going to make us lose distribution or skip distributions or anything like that. Um, so yeah, there's a lot of meat on the bone. And then our unfair advantage, WCG's unfair advantage. Again, broken record Tim saying we've done this time and time and time again. We have over 1,100 lots in 5 states. We are vertically integrated. We do everything in-house. We've found over the time that we've been doing this that doing everything in-house really makes it so we can effectively increase the NOI and keep our finger on the pulse of how things are going. And we're not waiting for a quarterly report from some third-party property manager that says, "Hey, by the way, I forgot to tell you, but 15% of your tenant base is left." So, we are day to day. We've got people working on the property management side, making sure that things are happening the way that they should be happening. Um, and then, yeah, the deal's unfair advantage. So, like I said, there's the 91 units that aren't producing full income. Matthias can tell you a little bit later, but when he went and walked all the homes, a lot of them need a lot less work than we had originally anticipated. So that, again, it's just, there's a lot of little things that are like, oh, wait, that's really good. Oh, that's good. Oh, that's good. Oh, that's good. That really add up to make this like great deal as is even better. So we're again excited about that. Um, and then so let's see the five parks here. Um, you know, they're all within an hour. So you go from one to the very last one is probably an hour drive from all of them. And there, there's nothing Uh, there's nothing different than what we usually do. All of the occupancy as is right now is really high. The Piedmont occupancy is a little bit lower, but it's opportunity, all of these things uh, that aren't currently producing income allows us to increase the NOI, increase the value, increase the cash flow. Everyone wins. And then check out cash flow portal and then you can download this yourself and like see the pictures. But Vinny is a master at taking really amazing pictures. I'm sure if y'all email him Vinny at WCG Investments, he'll send you his full like list of all the really cool pictures he took of all the five parks in Alabama. um, but yeah, it's pretty standard mobile home parks. And there's no red flags. The times we've been there, there's nothing that stands out as an outlier, as oh man, we haven't seen this before. It's all pretty standard to us. Um, I'm not going to go over this too much. I mean, this is beating a dead horse, really, because I kind of talked about the MSA. But yeah, there's a lot of different employers. There's people, who can, there's places where people can work, and that's very important in affordable housing. Um, I mean, I didn't go, but I know Vinny and Matthias went to the Honda plant, which is 20 or so minutes away from the Oxford Parks. Um, and yeah, there's a ton of different places for people to work. Again, it's right off the I-20. If anyone here knows the big interstates in the US, that's one of the biggest, right? From east to west coasts. Um, so yeah, it's really great because there's a ton of people who a ton of uh, products and whatnot that come through. There's a ton of yeah, just that the just a ton of work for people. And like what I like too is that it's a ton of it's a ton of work that anyone can get. You don't have to have a big college degree. It's not hyper needing higher education. It's very blue collar work, which is our bread and butter, and especially with this portfolio.
If I can chime in there, Tim. So Matthias and I, we traveled to the properties to do the walkthroughs and due diligence. Something that we look for every time we want to buy a park is where is the Walmart? and two of the parks have a Walmart like literally down the street. One of the parks has a university right next door. In fact, the tenants are were concerned that we were buying a mobile home park and demolish it and build multifamily because it's so pretty and it's right next to the university. I believe they're building a stadium right next to the park. Um, the hotel that Matthias and I stayed at is right next to a Best Buy, and one of the parks was like up the street. So it's a really, really good area where work is like everywhere. Oh, the Honda manufacturing plant. So Matthias and I drove to that plant, and it's 20 minutes away from one of the parks. So it's very central to a lot of business. So I don't know. When I was there, I was pretty excited. What about you, Matthias?
Yeah, absolutely. Also, the Honda thing is it's huge because I come from the manufacturing environment, like I mentioned in my intro earlier. So Honda was my customer in that facility. So once I saw that portfolio coming through, when we underwrote it the first time, I was like, oh, it's interesting. That's down the road from that Honda plant. And they have 2,000 plus people working there, but what many people miss is there's a huge supplier base around Honda. You talk about plumbers, electrical companies, HVAC companies just servicing the facility, and then these suppliers they're supplying any steel fabrication materials, plastic molding, and stuff like that, and everything that goes into that facility is tens of thousands of jobs around Honda itself. So one of those major facilities in that area is really a driving engine of that. So there's especially in Alabama, there's a lot of automotive in the area, especially Japanese and Asian manufacturers in general, with Kia further down south and stuff like that in Alabama. So that's pretty big. So I like to see those big manufacturers in the area. And then we don't only have that, we also have the Army Depot that's in the area as well, one of the biggest Army bases in the country. That's huge. And I love that we're on the corridor of the I-20, right? It's like the Oxford Circle and Clover Meadow, as you can see on the map. It's literally right next to the interstate. When I say next to it, it's like next to it. I mean, you can see the interstate when you standing in the parks. So that's how close they are. And people that live in these mobile home parks, they have blue collar jobs and they want to be quick on the highway and go to work quickly. They don't want to stand in traffic and need 20 traffic lights they want to drive through to get to the interstate. They're literally right there at the exit. So that's super strong. I love, I mean, what they say in real estate, location, location, location. This is one of them, one of those deals where location is really key.
Thanks, guys. Thanks. Matthias, I'm going to pass it over to you to go over your favorite thing, the numbers.
Oh yeah, I try to make numbers interesting. I don't want to give you guys the death by PowerPoint here. Let's talk about like top level numbers. So as Tim mentioned earlier, we have a 7.85 million purchase price. This is for 283 lots. The whole period is 7 years. When we say 7 years, it doesn't mean we're gonna exit at 7 years. The business plan is very robust, and our target is to be done with the majority of the business plan by 7 years. Ideally, you want to hold as long as we want to, especially when it's a cash flow and stabilized asset. We might hold it for 10, 15 plus years if you want to. So it's very open-ended. The fund target size is 5 million, and as Tim mentioned earlier, you might cap it at 4.5 million. This is the flagship pilot project in the fund because it's also very diversified already with 5 different parks, and we're adding on other properties along the way into the fund. But this is the majority of fund number one for us. And for this deal alone, the equity raise is 3.9 million in total, and the use of funds is the majority is really like the down payment that we need to get the deal closed. It's about $307,000 for the home rehabs, which is about 7,500 per home. When we got into this deal, we looked at $10,000 per home, but as we walked the homes, we realized some of these homes are rent ready. I mean, they're broom swept, ready to go. There were at least like 10 plus out of the 41 that are ready to go. We have to do nothing. Some homes that just need maybe $2,000 to $3,000, and somewhere on the higher end. So the average was probably more like the 5 to 6 range. We kept 75 in there as per home, just because I mean, everybody that did real estate long enough knows once you start opening things up, you discover new issues. So we want to have some contingency in our numbers to be very conservative. So that's how we arrived at 7,500 per home. Then we have $200,000 for park infrastructure. Think about landscaping. Think about security cameras. We always like to install those. And I'm still surprised to this day. Like every park that we're buying, nobody has. None of the owners have security cameras in place. It's such an easy add-on, relatively cheap. That gives the tenants a lot more security for within the park, right? Because we have cameras out there. So, and then also some road repairs that we want to do in the pocket as well. So that's what we're mainly focusing on. Then we have about $252,000 on infill capital, which is mainly for the down payments for these homes. We planning to use a Vanderbilt floor plan, meaning we only have to put 10% down of the total cost of the homes. So all in cost, like buying the home, transportation, setup, permitting, you name it, you're looking at like, 70 to $75,000, sometimes a little bit lower. 68 is the lowest I've seen. A total in some we're like in the high 70 range. So the average like 75,000 or so. So think about 10% down, that's 7,500, and then we have some extra for like site prep as well. So we're looking like $10,000 to $12,000 per pad to get ready. So the rest is acquisition fee, closing costs, and the reserves to get started. So we don't, have some dry powder to work with and don't start too lean when we get into this asset. Next slide, please. The lending terms, so we decided to go with the bank 5 Star. We have done several deals with them. As a matter of fact, the last deal we did back in December, we closed on. We also used 5 Star Bank, so we did several deals with them already. The loan amount is 5.3 million, 70% LTV. It's a 30-year AM amortization, 6.7% fixed. This fluctuates a little bit as 5-year treasury goes up and down a little bit. So call it 0.2 fluctuation. So interest only period is 2 years. Debt service 322, and then you have a day one DSCR of 2.27, which is the how well can you sleep at night metric. We love that we can pay the mortgage twice for this thing. So whatever comes a net operating income from the property, we can pay the mortgage twice and still have money left for pay operating expenses. That's how strong the cash flow is. So we really love this. We also have a lot of sponsor alignment there. Our Tim and I sign on the loan as well. So we have another key principal on the team as well that signs on the loan. So we literally put our house on the line for this deal. So we're signing a loan personally. So if anything would go south, they're coming after us. So we definitely have some alignment there with the limited partners and our investors. All right, next slide, please. All right, the financial projections. So this is very top level. In place NOI, we are looking at 818,000 as is. We did a full financial audit on the financials of the seller, or from the seller. We went back a full year on the financials and all bank statements and reconciled whatever we're seeing in there, rent manager, property management system report, and the accounting module within Rent Manager, and reconcile with the bank statements. So they actually came back even higher. I think they're actually at 838 in the last 12 months. So they're actually improving as they're holding this property. But when we underwrote the first time late last year, 818 was the in-place NOI, which is really strong. Stabilized NOI is 1.5 million. That's after 7 years. And we go into the details here in a second how we get there. But the base case is 17 to 19% IRR. You look at the equity multiple 2.6 to 2.8, which is extremely strong. So almost tripling your money in 7 years. Cash on cash, 12.94% average. It starts at right at 10% right out of the gate and goes up to 17 over the 7 years. So very strong cash flow. So if you're looking for cash flow, this is a good deal to go into. And then the refi, we look at 3 to 4 years when we have some really major value add done over time. So we not like to promise a certain year we do the refi. We always like to give a range because nobody knows what the capital markets are going to do. So we will see what the rates look like after a couple years and maybe cash in, get half of the investor base, their capital back, or maybe all of it, and then keep it for cash flow for infinite returns. Everybody stays in the deal if you have a capital event, by the way. Not every operator does that. We do it. So if you get all your money back, you have infinite cash flow. You just get infinite returns on your money because there's no money in the deal anymore for you. So then we look at the NOI bridge, how we getting that to that $1.5
Okay.
million NOI.
Let me
Next.
let me pull that up real quick
Yeah,
because I got to switch over.
you got it.
Okay.
Yeah, it's something I worked on just recently. That's why it's not on the final pitch deck. But once we have the deck with that final slide, we definitely send that out to the investor base and everybody on the call so you guys can see it. But this is the NOI bridge. So I just want to visualize for everybody, how do you get from 800,000 to 1.5 million? It's almost doubling the NOI in 7 years. So this shows you, it visualizes also how we love to have several levers to get to our goal in increasing NOI. So as you can see, we have an day one $818,000 NOI, and then you look at the lottery net normalization, which is like the first bump of $50 and 25 each subsequent year until year seven. That's like $464,000 chunk. So that's the majority of it of that increase. But then you also have the infill, which drives another $127,000 of income over the 7 years as we infilling those 21 lots. Then you have another 262,000 coming up on the income side, straight to the NOI for converting vacant homes into rent-to-own conversions, which also keeps the expense ratio low because they're going to be rent-to-own units where the buyer or tenant, in a sense, as they're buying it off with a lease with an option over time, they're responsible for maintenance, so we don't have any expenses attached to these units. We still have a capital reserve that we are maintaining and putting money into every month just because deals can come back like this, rent-to-own deals, and you might have to renovate them again and sell them again. So we definitely plan for that. We don't say, oh yeah, it's going to be zero expenses forever. But this is the straight NOI impact there. And then you have also ancillary income growth, which is as you're increasing occupancy, you have fee income coming up. Just even like late fees, application fees, etc. That's is actually 33,000 over the 7 years. That's increasing. And then you have a little bit of a shrinkage there because the expenses go up over time as well. So you have property taxes going up, insurance always goes up. Things get more expensive, materials, labor. So that compresses about another 155,000, and that closes the bridge at the 1.549 million NOI in year seven projected. So I just want to illustrate that, but I think that helps a lot. We heard a lot of questions on like, oh, how do you guys get there? We talk about what we do, but how does that translate to each strategy? And I love to see that it's very evenly balanced. So if you think about, let's say the infill falls short, you're still going to be close to 1.5 million. Or you just eliminate one category, you're still extremely close and increasing NOI by 400 to 500,000 at least if you completely eliminate one bucket. So we love that because there's a lot of to fall back on, and we don't have to, rush the business plan because each bucket is very easily achievable, if that makes sense. All right, the next
All
one.
right, let me switch back. I like that a lot. You're right. We do get asked all the time, how? That seems crazy. Going from 818 to 1.5, almost, 1.55. Like, how are you going to do that? And it's like, no, here's the magic. We do it by pulling a lot of little levers slowly over time.
Exactly. And we did in our Spartanburg portfolio that we closed on 2 years ago, we went from 240 NOI to 520 in 1 year. We doubled NOI in 1 year before, which this one's a little bit different animal in Spartanburg that we did because the seller had a 77% expense ratio and we got down to like 38.5 after 1 year because we did a whole different business plan than he did. This seller here for this portfolio for Alabama is more sophisticated and the other one was in Spartanburg, so you don't have that luxury to double NOI in 1 year, but it's very achievable to do it in 7 years. 7 years, there's a lot you can do. And we don't have that much going on in this business plan, so I'm super comfortable with this business plan. And we can jump to the next slide, which should go into the projected returns. So this, if you invest $100,000, so we have two different classes in our funds. So $100,000 is one example we have here because it's easy numbers. But if you invest up to $250,000, you get a 7% preferred return. And then there's a waterfall behind that, right? So if you put $100,000 in, you can expect, $7,000 per year, just for the preferred return. And then you have another profit share because we have a 70-30 split on the deal, meaning 70% goes to investors and 30% goes to the managers, which would be us, the general partners. So all the profits will be split 70-30. So you have another $3,000 coming in on that in year one already. And you're looking at over $10,000 in year one at that point, which if you run the numbers, that's over 10% cash on cash return, like right over 10%. And you can see how that grows. And then if you pay attention to year three, you can see how that dips down. And this is not an anomaly. This is just because the lending terms are 2 years interest only. And as we're increasing occupancy and also getting more, units online, the principal payments kicking in with the lender. So you're almost hitting exactly the same number as in year two because our income goes up, but also expenses go up with the debt service. And then you can actually go into year four and you can see the normal growth again. So all put together, you have a nice even balance. Almost, it's not a 50-50 balance, but it's a really good balance between cash flow and also exit proceeds, meaning if you refinance or sell, out of the $256,000, if you put $100,000 in, 93,000 comes from cash flow, 163 comes from the exit proceeds if we cash in on the value at the time. And there's deals out there, and talk to some multifamily operators. I mean, they put your preferred return on an accrual. It's ballooning somewhere in the system, and then they're promising a certain return at a certain time, but we actually pay them cash flow in the meantime, a lot throughout the holding periods, and we do that 3 months after closing, and then monthly payments, and then you see a lot of your returns coming from cash flow here, which it's because it's a heavy cash flow deal. It's a very safe deal. That's why you get to like a 2.5 equity multiple, because you have this nice balance between appreciation and cash flow. And on the next slide, we're going to go into, if you would invest $250,000 plus, you will get a 9% preferred return. So you can see the returns there. It's the same principle, it's just with higher numbers, right? So if you put 250,000 in, you get 652 out after 7 years. Then you have a 2.61 equity multiple, and this 244,000 comes from cash flow, and 408,000 comes from the appreciation from the value add over time. So, but everything else is the same. It's a 70-30 waterfall. You just get a higher preferred return, if anything, over 250,000 that you invest into this fund. And I have to add also, these numbers we just presented is all before tax savings. The reason we don't put those into our IRR numbers is because everybody's tax situation is a little bit different. Obviously, some people have real estate professional status and can take much more advantage of tax benefits than others. So some people just invest with us just because of the tax write-offs, especially in year one. But not everyone has a situation. So if you have certain ways of other active income that you can offset or use the passive losses from the K1s we would give you, these returns will be much higher from an IRR perspective, in a sense, because you put in a certain amount of money in, and you can have, $350,000, $400,000 of paper losses or more, if you put $250,000 into the deal. So this is extremely strong. And yeah, pass over to Tim for the tax benefits. He'll also talk about taxes. It's one of his favorite topics.
Look, I just like not paying them.
I
That's what
know.
I like so much about
Same.
them.
Exactly.
Yeah, yeah. So I've said it a lot before. Y'all might have heard me talk about it already, but so mobile home parks get the most depreciation of any commercial real estate asset. What that means is, the government, the IRS gives you a write-off, a paper loss um, for when you have investment properties. And um, what mobile home parks are able to do. We do a cost segregation, which breaks down the cost of all the components of every park and every home and every nook and cranny in the whole portfolio, and says, oh yeah, you can depreciate this and this and this and this. And it's a whole lot of really in-depth stuff that they do. But what makes sense to me and what I like is all of that, breaking things down equates to like a big negative K1 that you can either put against your active income if you're a real estate professional, or you can put it against your passive losses if you or your spouse are not real estate professionals. And Matthias was just talking about how all of the returns up there, we don't put in any of the depreciation, any of the money you're saving by not paying taxes into that, because everyone's different. Um, but I mean, we've saved tens and tens of thousands of dollars for our investors, if not more. I'd have to really look and do a poll and say, like, how much did you actually save? Because, on one of our deals, um, 2 years ago, actually. I have a friend who put $100,000 in, and he got a negative $142,000 K1. And he's a real estate professional. He does a lot of land flipping, so he just makes a stupid amount of money. It's like crazy. And so his problem is, how do I save a lot of that? And so he put the money into our deal. He cash flows every quarter, because this is before we went to monthly, but we're still doing, quarterly cash flow distributions. We haven't missed one, and he saved a whole ton of money that he, instead of paying it to the IRS, he put some of it into the investment that's actually producing him cash flow, building his wealth, building his, quarterly cash flow. And yeah, it's crazy. It's I think it's everyone's duty to really, take advantage of the system in the way that it was designed to be taken advantage of. And if the laws say, hey, I can do this, I can depreciate this against whatever income, then I'm very proud that we have figured that out, that we are playing the game as it's intended. And so as real estate investors, Matthias and I, we pay no tax because we're full time. But yeah, if you guys have questions about like what that might look like for you, let's schedule a call and talk about it. I'd say definitely talk to your CPA as well. Start thinking about, what your tax burden for 2026 is going to be and how this could potentially offset it. And, I talked and I said that mobile home parks get the most depreciation of any commercial real estate. And uh, uh, from the the emails we gotten back from Madison Specs, who does our cost segs from the proposals, it says that our investors are going to get roughly $1.50 for every dollar invested into this deal, which I mean, that's how rich people get rich and stay rich. In a short way. And that's over the last 6 years of really uh, not only studying mobile home parks and how we could get better, but studying wealthy people and how do they get wealthy? How do they stay wealthy? And that's how they do it. They hold on to a lot of their money through stuff like the tax code. But yeah, I could nerd about it like forever, man. Schedule a call with me. I'll talk your ear off if you guys have any more questions. But that's the depreciation on this one. And
Awesome.
Matthias, I think we're back to you. Yeah.
That sounds good. Tim is the mo most excited non-CPA out there regarding taxes.
I just like saving money. I
I
don't
know.
like paying money if I don't have to.
That's good. I love it. It's the biggest expense you have in life, man. Taxes. If you can save on that, that's huge. That's why we love real estate. Let's talk about risk mitigation. So we have underwritten the downside. So we've been doing it for a while, as you guys can see. We have 25 mobile home parks and 1,100 lots right now we have under management. And this is all done by our own in-house property management company. So we have our own back office that manages all the maintenance, the leasing, the collections, etc. And that is directly tied into the on-site team, the community managers we call it, which basically gives the back office the pulse of what's happening on the property, managing maintenance requests and stuff like that. So third-party management usually doesn't work out well because nobody manages your property better than yourself because it's your property, you care more, and we manage our stuff like we own it because we do. So we love to have our own property management company taking care of things because we get twice a day from the back office a pulse of the entire portfolio, which is for every single property of how collections look like, occupancy looks like, leasing looks like, and we're looking at dozens of KPIs every day. And we probably can do a webinar in the future on that as well, like how our KPI dashboards look like, because I think that would be good for investors to see as well, and how we manage these properties and how we have a pulse at all times. So that's how we like to manage those things. On the infill side, infill there can always be something happening where something can go wrong and it goes a little bit sideways, or you run into infrastructure issues and it gets very costly very quickly. Thankfully, on this portfolio, many of these lots that are sitting there have infrastructure already in place. It's just a matter of getting a permit and hooking up the homes on many of these vacant lots that we have right now. So, as you guys may remember, when I mentioned earlier, we have about $12,000 for earmark per home to bring in, and 7,500 for the 10% down payment we have for the homes. So you have a nice little spread there where we can, put some money in for the infrastructure work if needed, but the majority doesn't need it. Throughout these parks. So that's a huge advantage because we already know what we're up against because we already did the on-site inspections on the properties to make sure we can infill these homes. On the rent collection side, that's always tricky, especially in affordable housing as well, because there's lower income folks living in these parks. But it's as simple as sticking to your guns and knowing what works well. So we make sure everybody's screened properly, like it should be done. Many people say they do it, but they don't. They rush people into the system just to have paying people in the property. And the reason why we know that is because sometimes we buy properties and you can see people haven't been screened because they could never afford to live there. So that tightens up the process on our end because we know how a good paying tenant looks like and what their profile and avatar looks like. So we take that and that goes right into the point number one with the management risk that we have our own property management company and we know exactly and we control the lease and we know exactly what a good avatar looks like. And that helps us with collections, obviously. And the portfolio already has a very strong collection. So I must admit, like this seller of this property does a really good job of collections already. And the occupancy and especially two parks is pretty high already as we speak and as we go in on day one. So that's also really good and something to lean on as we take over. Also, you might ask, what happens when the market turns, has a downturn? Thankfully, real estate doesn't go up and down as quickly as crypto does, so like stocks in the stock market, thankfully. But it could be a downturn. But the good thing is, with mobile home parks, they're recession resistant because there's always a need for affordable housing. Think about people moving from class A to class B and downgrade from B to C and C to D. Same goes from like somebody lives in, maybe in a house and they can't afford it anymore, then they're gonna move to a mobile home or then move from an apartment to a mobile home. There's always somebody moving down into a mobile home park. So that gives a lot of demand for affordable housing, obviously. So that's really strong. We also have 6%, 7% fixed debt on the loan, which is for 10 years, which is amazing. So we have no major fluctuations throughout the time of we holding this asset, and that's why we love 5 star. They give us a really good rate for mobile home parks and also for a very long term, which is amazing. And again, the DSCR is 2.27, which means we can pay the mortgage twice and still have money left, which is awesome. So the sleep good factor is very high on this property. Next slide. Just this is talking about worst case scenarios. So you might say, okay, what happens if we remove some of the levers I was talking about, and how does the return profile looks like when I just say, hey, vacancy stays high. You guys don't infill because you maybe misjudge the market, or we can't sell them fast enough these homes over long-term rent-to-own contracts. How does that look like? So your returns still look at a occupancy staying flat at 67% total. And then the NOI stays at 818,000 compared to 1.55 million. If remember the numbers I was mentioning earlier, you still get a lot of cash flow throughout the time, and you're still gonna have a really good return of a 1.8 equity multiple because while your money is in the deal, you're getting cash flow because the cash flow is there already. So you get really good cash flow from day one throughout 7 years. So of course, and that cash flow goes up, it compounds, right? So on the rents don't grow scenario on the right, which is kind of like the worst case scenario, let's say everything freezes. Like for 7 years, we do absolutely nothing and just hold, which is extremely unlikely, but we like to have fun and look at those scenarios and see how that looks like. And it's the same thing. You're still just gonna get cash flow throughout time, and then of course you also have principal payments kicking in year three, and you have some really principal pay downs, significant pay downs happening from year three to year seven. So while you're getting cash flow, you're still building equity on the principal reduction side. And arguably, we could technically flip this property after we close right away because we buy it undervalue. Because we buy it at a 10.5 cap based on the Clover NOI. So if we just hold it for cash flow and we just basically return cash to the investor base, and then have just over time the principal pay down being our appreciation, you're still going to get 1.8 to 2.0 equity multiple over time, which is still above a break even point. So still very strong returns. But of course, we aim much higher, a lot higher WCG investments with all the little levers that we were talking about, what can be done. So that's why we have so much confidence in this deal. And yeah, I'm excited to get this started.
Awesome. Thanks, Matthias. Vinny, you want to take over?
Um, so yeah, as you guys know, the deal sits within the WCG Growth Fund. Target raise for the fund itself, it's $5 million. But like Tim mentioned, the fund was intentionally designed to be smaller The goal was to size the fund in a way that allows us to mainly take down this specific Alabama portfolio while still maintaining flexibility for additional smaller acquisitions and in the market that we already own. The target hold period is 7 years with the potential of refinance and return investor capital earlier, typically around year 3 or 4. From an investment standpoint, the minimum investment is $50,000, and the fund is structured for accredited investors under a 506(c) offering. Investors receive a preferred return of 7% for investments up to $250,000 and 9% pref for investments above $250,000. So when you put it all together, the fund is designed to deliver consistent cash flow, long-term equity growth, and tax efficiencies, all within a disciplined and repeatable investment approach. Next slide. So if you are interested in moving forward, the next steps are pretty simple. Go ahead and scan that QR code that you see on the screen. That's going to take you directly to our cash flow portal. Inside of the portal, you'll be able to review the full PPM and offering documents. You can create your investor profile. You can submit your soft commitment, execute the documents, and that's where you submit your investment as well. In terms of timing, closing is scheduled for June 19th, and wires will officially open on June 4th. So this is a first come, first served offering. Our last deal that we closed at the end of last year was fully oversubscribed just a few days after our live webinar. So if you're interested, and you have questions, just let us know. If you have questions or issues through the process with Cashflow Portal, let us know. We're here to help. So with that, we appreciate you taking the time to join today, and we open the floor for questions. So feel free to unmute and ask your question.
Vinny, I'm going to go through first all the typed up questions, and then we can open the floor. And I think everyone's here who typed in the questions anyways. Jason Valley, is this a closed-ended fund with a fixed close date of 7 years? So this is a closed-ended fund that, we've said a couple times we'll probably close it around $4.5 million. So it's likely going to be closed in the next few months, honestly. Yes, we have another deal, a smaller deal that we're looking to reposition and put some money in, but yeah, this deal's the lion's share of the fund. Let's see, Vinny, can you describe the major employers along with the industries in which the tenant base primarily works? Do you guys still have questions about? Do you guys still want us to talk about the employers?
You can also show the map, and it shows all the industries around the parks. Maybe that question came up before we got to that slide.
I think it did.
Yeah, I think I saw it coming through right at the same time. Yep, absolutely.
Oh, Scott, unmute.
Yeah, that's just
Come on, bro. Come on.
No, that just some additional context on the water flow structure. Definitely. I know all you guys, Vinny, and we haven't had the opportunity to meet yet, but I know Woodbridge the best, and Matthias was a lot of help to me. I was just curious if maybe in the cash flow portal there's a waterfall chart that kind of goes through what I just put into the chat there.
Here, let's see. Let's talk about both your questions. So the first one, hold period, 7-year hold period with a potential refi in year 3 or 4. Yes. And when,
So that one is really just predicated upon what's the probability on a refi before the 5 to 7 year? 50-50?
I'd say more than that, but also I don't know where the capital markets are going to be. So we don't force refis to return capital if it's going to hurt the overall deal. So it really depends. But I can say, we are doing it to 2 deals this year that we closed 2 years ago. So 2 of the 3 deals we're refining this year that we closed in 24. Um, so, not 100%, but as long as it makes sense to refi it. Um, I can tell you it is very, very, very top of our mind to return y'all's capital as soon as we can to selfishly make it so you guys love us and you want to keep investing with us and keep putting money towards deals because we want to buy all of the mobile home parks. We have really, really, really big plans for growth, and we want y'all to come with us and get rich with us. So yeah, it is a big I guess, a big conversation that we have behind the scenes. It's like, okay, is this appropriate? Should we be talking to people? And, uh, hey, this looks good, but we don't know 100%. Let's talk to Judah from Princeton Capital, who is a rockstar loan broker. Or let's talk with our partner, Hyam, who is also a rockstar loan broker. Hey, what do you guys think? We collaborate with everyone and make sure, okay, does it make sense to refi now? Yes. If so, that's amazing. Uh, we're refining Sherwood Forest, or we're returning all investor capital. And again, selfishly, I hope that most of the investors take that money and put it into this fund, and we close it up really quick, because that's it. I know that we all know that treating our investor partners super, super well is how we grow consistently and grow really, really big. So yeah, that was a long-winded way of me saying probably.
Yeah, it really depends on what the interest rates are really doing there, Scott. So we're saying 3 to 4. It could be sooner, right? Like Tim said, Sherwood Forest, we have owned that under 2 years actually, and we're already refinancing and giving the investors their initial investment back. So it really depends. But our intent is to give the investors their money back as soon as possible.
Now with the
Okay.
fund, would the return of the principal be, on a per deal basis because the fund is capturing, the Alabama portfolio, and that was a part of the verbose second, thing I put into the chat there. And I don't want to hijack. You and I need to connect, Vinny. I do want to get involved in this because, Tim, quite frankly, and Matthias have proven themselves to me, and I have gotten involved in a number of other syndicated deals with trusted people, and I wouldn't be, even on this call if they hadn't proven themselves to me as trustworthy people. But I have not, gotten involved in an LP position, in a mobile home park, but I didn't see a slide in there around, the waterfall structure, which is, essentially, what I put in the second bullet there. So we can talk more about that, Vinny. It's not
Matthias, you
going to
wanna you wanna
preclude
brush
my
on
interest.
that?
Yeah, we
Yeah,
can.
yeah.
Let me go into the question here directly because I think there's several questions at once, just on a high level, and of course we can, of course, yeah, connect after the call, obviously. Let's see specifically where the pref is cumulative. So let's for some reason we won't pay the pref. Of course, that would also accrue, obviously. Cumulative. What do you mean with cumulative for the pref, Jay? Exactly.
Well, just in terms of before the GP, receives money, you all
So if we
relative to
don't pay, if we would pay no pref or like a short pref, we won't get anything. We always say investors get paid first before we get paid. So we always do that first. So the waterfall doesn't really kick in until like the full pref is paid, which is getting the investors paid first. And after that, it's going to be basically a profit split.
got it.
There's no IRR hurdles. That was one of your questions as well. We don't have that really in there. And then how the refinance proceeds are distributed, it's always return of capital first, and then from there it's basically just like the profit split again, basically the 730. So that's always, I mean, any capital event is going to be always first return off the capital. And then also, if there's recapitalization, yes, the LPs will definitely keep receiving not a pref payment because if the capital is returned, there will be no preferred return on any capital because there is no capital anymore. But you will get if there's $100,000 of cash flow, I mean, there will be more for this deal, especially, but there will be a 70-30 split. So you would basically get like infinite returns because there's no capital base for you anymore in this deal, but you would still get cash flow. So that preferred return will actually be eliminated if all the capital is basically returned.
Yeah, the investors would get that 70,000 of that $100,000.
Exactly. Yeah,
Pinpoint.
thanks.
Yep. Good job, Matthias. Appreciate it.
Yeah, no
We
problem.
don't
Good
we
questions,
don't do a
man.
lot of sorry, we don't do a lot of hurdles and stuff like that, because it makes things more complicated than they need to be. Um, and so yeah, especially deals of this size and smaller, it's like we keep it really, really simple. Y'all get money, and we want y'all to get money because then we get money. And that's, how everyone stays really aligned. Jason,
Also,
you
if
asked,
just one question,
sorry.
one thing real quick. If Kripal is still on the call, I just send a link in the chat. I think he just also the major employers. I think he had a follow-up questions there. But are those same companies in industry the primary employers of the tenant base? I would say so, absolutely. Because if you look on that link I just sent you, it's Honda Manufacturing. They're actually at 4,500 right now. I mean, I worked with them; they were at 2,000. They were doubling in size in the last 10 years, which is amazing. So I would definitely say they're definitely a major employer for our tenant base because it's manufacturing blue collar people. And you can also see in the list, there's also companies like BAE Systems, which is supplier, FabArc, Steel, General Dynamics, all blue collar jobs. Bridgewall Interiors, which is a supplier for Honda as well, and many others. And this also how supply bases work, and I have the insight because I've been working there for 18 years. But if there's an interior manufacturer like Bridgewall Interiors there, they're not only supplying Honda, because they have a foothold there. They're also supplying Kia down in Georgia. They're also supplying BMW up in Spartanburg, South Carolina, because they have the local presence there. So that actually it takes a major amount of capital to go into these markets to get a facility started in manufacturing. So if they are there, it's a very sticky employer base. And manufacturing is like very, very blue collar employment base with manufacturing. So that's why we like this market so much because it's right at the heart of our tenant base.
Thank you, thank you.
Absolutely.
Um, let's see, Jason, you asked, where would we find all the fees charged by the GPs? So all that, there's a 2% fund management fee. Um, that is pretty industry standard for managing the fund. All of these fees are on the deal level, but I can tell you what they are. And when we have, so the fund will be like the investor into the Alabama Portfolio LLC. And so like there will be a whole nother operating agreement and all that fun stuff. So when we have that all written up, we can send that to everyone. But let's see, acquisition fee, we do 3% of purchase price acquisition fee, uh, disposition fee, deposition fee, 1%. Um, for property management, we do 10%, paid to our property management company to pay our people. For asset management, we do 3% of gross asset management fee. Um, and I believe those are all the fees that we have in there.
Correct. Yeah, asset management fee is 3% of gross income, by the way. So it's aligned with the more money we make, the more money, we make it also as asset management. So it's aligned there. It's not a flat fee. Some do flat fees. We like to align it with a performance metric, which in this case, gross income. And also you might say like, okay, those percentages sound a little bit high to me, which is a good challenge, but our rents are a lot lower than multifamily. So if you look at apartments and multifamily, their rents are like 1,500, 2,000, 3,000 in some markets. So, and also purchase prices are the same way. If you buy a 283 unit multifamily property, it would be a lot more expensive than 7.8 million. So the percentages are higher in the MHP industry because the rents are low and purchase price are low compared to multifamily. Just keep that in mind if you hear those percentages. They're like a tad higher than multifamily, meaning apartments. But it's for that reason that, the rents are lower and the acquisition costs, prices are lower in the MHP industry.
Do we have any other questions?
The only other question I'd have, so Tim, nice job on going through the fees. I'm not certain what the slide number was, but I've got the original deck that Vinny had shared with me, and you covered off on the acquisition fees on it's investment highlight slide if you go to that one. So, the dispo asset management, everything else is yeah, that one. So everything that Tim went through, I saw the acquisition fee there. Are those others factored in on this slide, or are they captured somewhere else?
No, they're not because so this is all really just the fund. And so Jason, you said, are all these fees listed in the PPM? They're not because the PPM we have right now is just for the fund. For the deal, it'll be more of a simple joint venture thing, and they'll all be put into that operating agreement. Um, it hasn't been done yet, but when it's done, we'll share it with y'all.
10-4. Thank you, sir.
Good to see you, man.
Good to see you too, man. No more deal room calls. I appreciate everything you've done, Tim. You too, Matthias.
Yeah, man.
We've kind of taken a shift on the mobile home stuff. You guys have figured it out and, putting money to work and letting you guys do it as the experts and, really rolling up the sleeves with, the triple net flex, which quite frankly, more closely aligns with Scott Porter's personal and professional ambitions. So good job on the
Good.
call today, guys.
Thank
Thanks,
you.
man.
That means a lot.
Thanks. Yeah. Yeah, we nerd out on this stuff. I know I've already said it, but we found our lane and we know what we're good at, and so that's just what we do. Um, yeah, I mean the big goal is ending homelessness by 2050. And it's not something that we'll do alone, but we'll be part of that movement. So super excited. So my number is 928-460-0602. Shoot me a text, we'll set something up. And that the same with anyone here. If y'all want to talk more, um, email, text, whatever, we'll make ourselves available.
Yeah,
I
in
put my
fact,
number in the chat. If
at
in
the
case
end,
anybody wants to talk, NOIs at 2 in the morning, feel free to call. I'm always available.
Ah!
so my number's at the end of the slide deck, but I'll add it in the chat as well.
Oh yeah, yeah. Here, this is where we're supposed to end. Yeah,
Yep.
so y'all got that call to action right there. It's like, do it. Marketing 101. Cool. Anyone
And
else got any questions at this time?
yeah, any last minute questions?
No, I don't think so. Good on you guys for getting David on the call. We got to know him a little bit, swinging the bat on the LOIs. So you're either buying it through him or he's going to be an LP. If the latter, even better. But thank you guys again. I appreciate it.
He's a great guy. I love him. I'm excited to work with him. All right, friends. Thank you guys so much for showing up. Vinny, I'll let you take us out because you're better at it.
Yeah, no, I have nothing. Thank you guys for joining. It was a really good conversation. If you guys have any questions, you have our numbers down there. We can text and schedule a call. You have my cash flow portal. You have my cell phone number on the slide deck. Yeah, reach out and thank you for joining. And we look forward to working with you guys in the future. You have a good evening.
You as
Thanks
well.
very
Thank you
much.
Thanks,
guys
guys.
so much.
Bye now.
Thank you. Bye-bye.